Welcome back. U.S. futures, as we just saw, are under pressure after U.S. President Donald Trump has said he intends to send letters to U.S. trading partners over the next 1 or 2 weeks, setting unilateral tariff rates ahead of a July 9th deadline. For more on what all this means to the markets, let's talk to Ed Clissold. He's chief U.S. strategist at Ned Davis Research. He joins us now from Florida. Ed, thanks a lot for joining us. I know that you are of the view that tariffs will knock about 50 basis points off S&P 500 profit margins in the second half of this year. How concerned are you? How concerned should investors be at the latest tariff talk coming from the U.S. president, in which he said that he intends to notify numerous U.S. trading partners within the next couple of weeks of unilaterally set tariffs on their goods coming into the United States?
Thanks, Paul. I think today's news, or yesterday evening's news, is just indicative of what we're going to have to deal with over the next several months. It continues to be a news-driven market, which then makes it a sentiment-driven market. We've had a nice bounce, off of those post-Liberation Day panic lows. And now we're going to have to deal with the continued uncertainty of whether or not, what those new tariff rates are going to be. Do we go to the brink once again? But what I think we've seen so far is that companies have prepared fairly well for it and can manage it for a while. I think the risk is, if this keeps going, not just a 90-day pause or 180-day pause, but keeps going for several more quarters, then the pause in capital spending, which has started to take place, becomes more permanent, and that has a bigger impact on the economy. So that 50 basis point hit to S&P profit margins is kind of predicated on the worst case scenario not happening. So there's downside risk to that if this keeps going. Again, it's not just where the tariff rates end up being at, it's how long do we know what they're going to be.
You mentioned Liberation Day. That was in early April. Yesterday, we got U.S. inflation numbers for the month of May, so substantially after the announcement of those tariffs. We didn't see a big surge in inflation. In fact, the numbers came in softer than economists had expected. What is your view on whether or not we will see a significant uptick in U.S. inflation driven by tariffs on incoming goods?
The worst is probably still to come because, again, companies front-loaded and imported before Liberation Day, not even knowing exactly what it was going to be. So that bought them some time. Companies are also absorbing some of the cost in the beginning. That's why we think it's going to hit profit margins. But you're going to start seeing this filter through as we go. I think the question is to what degree it is. I think even before yesterday's CPI report, we had a couple of other softer CPI reports that reflects the economy had softened a little bit. And so that did give us some wiggle room. What we're watching is the CPI in a 6-month moving average. If you get substantially above it, say more than a 0.5 percentage point above the 6-month average, that's when stocks in the U.S. tend to really notice. So right now we're about 0.3 below the 6-month average. So we have some wiggle room, even if we get a couple of hot CPI reports. But again, it's really about the longevity of this issue. Does it keep compounding upon itself, or more tariffs come on every few months, and then what could be just a one-off adjustment to inflation becomes something that's more of a sustainable uptrend in inflation? That's the bigger risk to stocks.
So what is your view of where the U.S. Fed is going? When the market saw those weaker than expected inflation numbers yesterday, it immediately, the Fed funds futures market immediately dialed up its expectation of rate cuts to 2 rate cuts by the end of this year, 2 25 basis point rate cuts by the end of this year. What do you think we'll see from the Fed?
We've been a little more dovish than the market for several months, thinking the Fed does have a little bit more room, assuming, again, inflation doesn't get completely out of hand, because even at a 3% inflation rate in the U.S., and again, we're well below that right now, the real Fed funds rate is a little bit restrictive. So The Fed is unlikely to do anything in the next couple of meetings. So after Jackson Hole, which is in August, the September meeting we think is on the table for a rate cut, and then there's two others after that, and they could cut once again. So two cuts this year is on the table. I'd say 1 to 2 is a reasonable expectation.
Okay, with all of that in the background, what sectors of the U.S. stock market do you favor right now?
So we like large cap stocks over small cap stocks. At this point in the economic cycle where growth is slowing, a little more challenging environment, large caps tend to navigate that better. And then we like growth stocks over value stocks. When growth is harder to come by, you tend to pay a premium for the companies that can deliver. Those are growth stocks. And even if you look at some of those mega cap growth companies, they've already had a valuation reset earlier in the year. Moving forward, those earnings revisions related to tariffs are likely to not be in those mega cap growth names for the most part. And so that's where we'd focus. If you want to pick a sector, discretionary is our current favorite, but we also like generally the other growth sectors, technology, communication services.